Hi there, good afternoon and welcome to the Mutual Fund Corner. I'm Manglam Malu. With me is Sumaira Abdi in the Mutual Fund Corner. Like every Tuesday and Thursday, we answer all your mutual fund related queries. But before that, we take a look at our markets. The intraday recovery on the Nifty has been sold into. Currently, we're sitting with a cut of almost 90 points on the Sensex, nearly 30 points on the Nifty. But it's all about individual stocks. Z is the one that takes your breath away on the downside. Down about 9%. Bank of America, Merrill Lynch downgrade coming in. They believe there could be no upside even if the deal of promoters bringing in a strategic partner goes through. Add to that, we have UPL, which is also extending its cut, sitting with a cut of around 3.5%. Not good commentary coming in from the Bayer conference call. But first up, we run you through all the top stories and then answer all your mutual fund related queries for the medium to long term. Markets significantly off the lows of the day, still in the red. Infosys and HDFC Twins drag, while L&T and M&M provide some support. The mid-cap index marginally outperforms. The oil marketing companies, they celebrate as crude prices slip below $59 per barrel. Lower oil prices, remember, pushes up yields and helps strengthen the rupee, which is trading near a one-week high. PSU banks, they jump in trade on the dual tailwind of higher bond yields and potential benefits coming in from the farm loan waivers announced. The brain trust of JP Morgan remains bullish on resumption of the investment cycle and earnings outlook. Expect a rate cut from the Reserve Bank in the first half of 2019. cnbc TV18 learns that big-ticket rate cuts are unlikely in the GST Council meet on the 22nd of December. Sources say that states and centre remain concerned about revenue implications. Remember, this is a cnbc TV18 exclusive. All right, and with that, and the market sitting with a cut of about 24 points, we give it off to Sumaira. Sumaira, take it away.
All right, Mangalam, thanks very much for that. My guest this afternoon is Feroz Aziz of Anand Rathi Financial Services, who joins in to answer all our mutual fund queries. Hi, Feroz. Good afternoon. Thanks much for joining in. Let's get cracking right away. Our first query comes in from Mr. V.S. Rao, who's on the line with us from Bengaluru. Mr. Rao, good afternoon. How can we help you?
Yeah, very good afternoon. Yeah, sir, actually, I have invested this HDFC Balance Advantage Fund RGPL dividend payout about 5 lakhs.
Okay.
Yeah, actually, this is it advisable to keep this amount, or can we split into some other beneficial mutual funds, if any?
Okay. Sir, what exactly is the nature of this investment? I mean, what do you need this money for? What have you invested it for?
Yeah, actually, this is for a monthly payout because I am a retired person. I am aged 65 years.
Okay, so basically you're looking for a monthly income and hence an investment to that effect.
Yes.
Feroz, he has money in the HDFC MF Balance Advantage dividend payout scheme. But is that the best way to actually schedule your, a monthly payout? I mean, should he remain invested like this, or does he need a change?
I think he certainly needs a change because quite a few advisors have given balanced funds on the pretext that there would be a regular dividend. That was a thing of the past. When the markets are doing well, you get dividends, Mr. Rao. And point two is there was no dividend distribution tax, I'm sure, if you've bought this before April 1st. So dividend distribution tax is a one large change to the inflows you're getting. And if you take a balanced fund, if the market's not doing too well, you're actually eroding capital and you're taking money from your own capital and paying a dividend distribution tax on gains which don't exist. So please make a change. Split the money into two portions, 60%, which is what the case is now in equity, by Reliance Large Cap Fund, Mirae Asset India Equity Fund, and in the mid-cap space, Kotak Emerging Equities. Buy 3 funds for yourself, not one fund, and then use a debt fund. Reliance Credit Risk is a good debt fund to my mind, and then put some money in a liquid fund and do a systematic withdrawal plan to get the recurring inflow into your bank account. If you do this combination of these 5 funds with a systematic withdrawal plan on the liquid fund, it will be far beneficial from the long run.
Mr. Rao, I hope your query is answered.
Yes, madam. Actually, could you please repeat this? What are the, because I am new for this, mutual funds or stocks or whatever it may be. So what are the, 5 points, these Reliance and the Kotak?
So if you can-
I'll repeat this for you, Mr. Rao. First one is Reliance Large Cap Fund. Then you have Mirai Asset India Equity Fund. The third one is Kotak Emerging Equities Fund, Reliance Credit Risk Fund, and then a liquid fund, maybe a HDFC Cash Management Fund. The liquid fund those are fungible. You can buy any liquid fund for that matter. So HDFC Cash Management Fund would be a good fund. So these 5 funds, if you make note of these and invest your monies equally in all of the 5 and do a systematic withdrawal plan, that will be good. And if you're not using an advisor, use direct option. Don't use the regular option like you specified.
Okay, and Mr. Rao, we also will put up Firoz's recommendations on our website, cnbctv18.com, so you can always log in and catch the recommended fund scheme names over there. Up next, Siddharth Mishra is on the line with us from Pune. Hi, Siddharth, what's your query?
Hey, hi. Thanks for taking my question. So I have a bunch of mutual funds. This is basically a combined portfolio of me and my wife, looking for about 12 to 15 crores after 20 years. And this is primarily for our retirement, and then about 1 to 2 crores after 15 years. So I just wanted a review of my mutual fund schemes, if these are the right schemes, or should I consolidate a little more on the number of funds, or are these the right funds?
Okay.
I'm investing in direct growth funds. And apart from the few SIPs I have, I also have a few other funds on which I've stopped investment by the amount. So it's about 15, total about 15 schemes that I'm currently invested in. So is it too much, or should I consolidate a little more? So that's the question. Yeah, thank you.
Okay, so Siddharth, first of all, congratulations. You've got started. You've identified clear, actionable goals with a quantum attached to it. Quantum's also not unreasonably unrealistic. The only concern I have, Firoz, is that, by his own admission, the number of schemes are too many. There is an emphasis on tax saving over here. And, the lump sum ones, he has about 8 lakhs over there. So can he put that money to better use now? Siddharth, I'm assuming that you don't have any lock-in or anything in any of the lump sums, right? They're all free to use as required.
Yeah.
Okay.
Correct, yes.
Okay, so he has 2 goals. Is he on track to achieve his goals? So far, he just has under 80 lakhs accumulated.
I think he's on track to achieve his goals because Siddharth, you're 39 and you're speaking of retirement and you have long periods of time and compounding is going to be in your favor. I think you will be able to achieve more than what you've envisaged if you stay the course. Point 1. Like Sumaira just mentioned, that there are more schemes than required because all of these are optically diversified. They all converge back into the Indian capital markets, largely equity. So you might think that you have 15 schemes diversifying your money, but there would be a large intersection between one fund manager's choice, especially in the large cap space with another fund manager. So the optimal number of schemes statistically is about 7 to 8 schemes. So you have a scope of eliminating 7 to 8 schemes from your portfolio, shedding the tail and becoming a little more focused and concentrated. That's the only reason why you're paying a fee to beat the market. It's impossible to beat the market by buying the entire market, which is what you've done. That's point 2. Point 3, when you're choosing schemes, and you've mentioned those schemes which you've sent us, I would say that you have some schemes to get rid of. One is, of course, SBI Blue Chip Fund, where you have 20,000 rupees per month being invested. That requires a change. You need to also eliminate HDFC Midcap Opportunities and L&T Emerging Business Fund. These are the 3 ones you can actually redeem from your portfolio. Also, the money which is accumulated and also the further inflows should stop, in my opinion, and then you can choose other 3 schemes: SBI Focused Equity, Reliance Large Cap, and Kotak Emerging Equities. These would be more contemporary from a next 2-3 year perspective, Siddharth.
All right, Siddharth, I hope that answers your query.
Yeah. Thank you.
All right. Apologies. Thanks very much. Nakiran Shrigiri is also on the line with us from Karnataka. Go ahead, sir.
Yeah, hi Tim. My query is mainly related to excuse me. I have about 10 lakhs of lump sum amount available, which I want to invest in mutual funds that I have shared with you. My objective is to double my investment in a time frame of 5 years. The portfolio that I selected, my split would be around 60% into small cap and the remaining 40% in large cap. So my question would broadly be, how do these mutual fund picks look to you guys, and do you think I have over-diversified with a lot of duplication going on? So that's where my question lies.
So I think, Nagakiran, I think your choice of funds is reasonable. I think you have not over-diversified. You have an optimal number of funds. So point one, Nagakiran, the number of schemes are okay. Point two, of course, there could be one or two schemes which could be replaced, or at least your choice could be minorly modified before you embark on this journey of creating wealth for yourself. Point three is you want to double your money in this 5-year period, which implies that you will earn about 15% per annum. Let me also tell you that this consistency of performance in equity markets is an uphill expectation. So there could be ups and downs. But I think, is your expectation fair? From equity funds, expecting 15% is a fair number, and money should double ideally in a 5-year period. In a debt fund, it takes about 8-9 years to double, or even little more. But equity funds have the potential to double it sooner. But it's not going to be a linear path of making money. It's very important for other viewers who are new investors, because mutual funds don't produce magic at all. They're boring, dull instruments which require long periods of time to establish their performance and track record.
All right, Nagakiran, I hope that answers your query.
Yeah, just is it on the riskier side, the portfolio that I have picked, or do you think that this is achievable with all the caveats, of course?
See, I think your one of your funds, the SBI Small Cap Fund, I would recommend you against it. Axis Mid Cap Fund. What happens is, whenever you are in the mid cap and the small cap space, you will have to be more picky of the fund. I would say Kotak Emerging Equities Fund could be a better choice. And in the large cap space, I think the intersection between different fund managers is similar. So I think you can be agnostic to several other funds and pick one of them. But in mid cap, please do a little more homework. So Axis Mid Cap is something which I would recommend against. And if you've already invested, I would ask you to exit that and move into Kotak Emerging Equities. I think your split between large cap and mid cap is focused more on the mid cap side. You can also add, for further investments, Reliance Large Cap Fund, which is a stable fund. I think that will bring in more stability and reduce your risk considerably.
All right, Nagakiran, thanks very much for calling in. Let's take a very quick break. Firoz stays on with us, and more mutual fund queries on the other side. Stay tuned. Hi, welcome back. You're watching the MF Corner. Firoz Aziz of Anand Rathi Financial Services is with us. And the next caller is through to us as well. Ishwar Revant is on the line with us from Karnataka. Hi, Ishwar. How can we help you?
Yeah, good afternoon, ma'am.
Good afternoon. Tell me.
Yeah, ma'am, I was about to start my investment career, ma'am.
Okay.
Yeah, I would like to know which are the best in mutual funds to start with me.
Okay, so you've
I
just...
can take a bit risk, ma'am.
I'm sorry?
Yeah, I can take a bit risk also.
Yes, I'm assuming you should, in fact, because you're only 22 years old. I suppose you've just started working. So good that you have started on this journey. Firoz, for somebody who's just getting started, I think it hardly matters what's the quantum you have chosen, right? Because even if you start small, you have enough time on your side to, not just catch up, but actually build a sizable corpus. So I'm assuming that he has a minimum time horizon of 20 years. Is that right, Ishwar?
Ma'am.
You don't have any immediate goals, right?
No, ma'am, not
Okay.
right now.
Okay, so let's assume a minimum time horizon of 20 years. How should he get started?
So I think starting at 22 is commendable. I think you have more time in your favor and compounding. which we all discuss, is going to be in your favor, and that's going to matter a lot. So point one, great that you're starting out. Point two, generally when, like you mentioned, Ishwar, that you can take more risk. It is because your earning life is just going to get started, and you have long periods, so you should be taking more risk. But please be clear that risks are a measured variable, and risk needs to be measured, and they're measured in something called standard deviation. This is something which I think every viewer should take note of. We generally, when we use risk as a word, we use English nomenclature, not mathematics. Return is measured, risk is not measured. When you choose funds, and if you want a higher risk, then you choose funds which have greater than 15-16 standard deviation, and that will give you that little extra return. So let me recommend to you 4 funds, depending on what quantum you're starting with. You can start all of them at once, or maybe stagger them and start a few of them when your corporate's investable surplus goes up. Mirai Asset India Equity Fund, Reliance Large Cap. You can definitely look at a fund which is Canara Robeco Emerging Equities and HDFC Small Cap. This will have a tilt towards mid cap and small cap as a portfolio, which will give you that extra return vis-a-vis the large cap funds, which tend to mirror Nifty and Sensex more so.
Okay, Ishwar, all the very best. Thanks very much. And we hope you'll keep checking in on regular intervals. For now, all the best. Up next, Yashasvi is on the line with us from Mumbai. Hi.
Hi. I'm Yashasvi, 24 years of age. I am investing 20,000 rupees per month in 4 funds. I think the detail has been provided.
Yeah.
And my goals are buying a home and international travel in around 10 to 15 years. So I just needed overall guidance on my portfolio and if I can do some changing.
Okay.
Or look for any other ETFs or index funds. To
Okay.
lower
Any
the cost.
reason you're looking at a ETF or an index fund? I mean, what is the reason?
Just to lower the cost.
Okay. Firoz, he's again a young investor, just 24 years old. The good part is that one of his goals is travel, and yet he's looking to delay it by 10 to 15 years so he can save enough for it. So that's good. The second goal is to buy a home. How much are you looking to collect for both these goals, Yashasvi?
I don't have a number in my mind, but
Okay. Okay. All right. So he's not yet narrowed down on how much he'll need, but nevertheless, he's putting in 20,000 rupees a month. Is he on track, and does he need to add an index fund?
So I think, fortunately, all the 4 funds, Yashasvi, you're investing in are good funds. So I would say 9 on 10 from a portfolio construct perspective. Point 2, I think when it comes to goal setting, anything to do with numbers has to be written down, and your goals have to be precise in nature so that you can plan and work backwards of what is the investment amount you will need per month, especially when you're planning to buy a house for yourself, which itself is an asset. Real estate is an asset, so you'll have to make sure that you beat the price rise of the house which you wish to have or aspire to live in. So that's point 2. Point 3 is ETFs, of course, like you specified, have a lower cost. But in my opinion, and at least last 10-15 years of data clearly exhibits that India is a little away from moving from an actively management strategy to a passive managed strategy. If you compare yourself as an industry to the US, of course, US has moved towards ETFs, but I think we are a long way away. And I think you should rely on active managed funds. If you want to reduce cost, you can definitely use a direct option. But I would suggest that going for passive funds will surely not create the alpha, which has a reasonable probability in an active managed fund. So please make sure that you choose active funds as against ETFs.
Okay, Yashasvi, all the very best. In fact, it looks like it's an afternoon of younger callers. So up next, we have Dhruv Shailesh, who's on the line with us from Mumbai. Hi, Dhruv.
Hi, good afternoon, ma'am.
Good afternoon. How can we help you?
So I'm 24 years old, and the thing is that I've got about 4 lakhs of investment in HDFC hybrid debt fund. So that's a monthly income plan. This was invested by my dad. So that the thing is that I don't need the monthly dividend anymore because I just started working recently. So I'm looking to reinvest this amount into something that can give me good returns for next 20-25 years. And my second query is I have IDFC Sterling. Yeah, that's this one. So I have an SIP of about 10,000. So should I continue with that fund or should I just stop with that investment?
Okay, Dhruv, so first up, congratulations. Good that, you've realized that you need to switch out of the debt fund that you've been carrying. And good that you've called us also to talk about this ELSS. I have actually points to make on both, but I'm going to hand it over to Firoz first. Firoz, he's just 24 years old. He had an investment made for him. He's looking to now redeem the debt fund and, move on with life. Secondly, on ELSS, we don't see very often that people have a SIP into ELSS. Normally, they just look at it, in December, Jan. So this is a good thing as well that he has an SIP. But is 10,000 too much, of an SIP into an ELSS fund?
I think so, because 1.5 lakh is the limit. So point one is, if you're buying yourself an ELSS, make sure that you are buying to the extent you get a tax rebate. If you've already crossed that threshold, because that 1.5 lakh threshold is fungible. It includes insurance premiums, it includes employee provident fund. It now also includes NPS as the recent circular which came from the finance minister. So point is, please don't extra invest in ELSS. IDFC, of course, could be a good ELSS scheme, but let me tell you, Reliance Tax Saver or Access Long-Term Equity would have a better prospect from the next 3-year perspective, because there is a lock-in of 3 years, so you'll have to be a little more careful. And you have to also remember that every installment will be locked in for 3 subsequent years, and not just the first installment period needs to finish 3 years. But I think, like you very rightly pointed out, Sumaira, it, I think, is something for all viewers to learn from, and not do tax planning at the fag end, where a person as an advisor might capitalize on your urgency to do it and give you the wrong product without understanding your need that much. So I think that's one very valid point highlighted.
And what about the debt fund? What does he switch to?
So I think debt fund where dividends now, of course, because it is in the debt category, the dividend distribution tax is also on the higher side. So if there is 20-25 years, debt has no role to play in the portfolio. Take 3 funds and distribute this money, this 4 lakhs, into different funds, because you can't buy one equity fund. So you can look at Mirae Asset India Equity Fund, Kotak Emerging Equity, and HDFC Small Cap. These 3 of different categories will complement each other and give you a stable portfolio, I would think, Dhruv.
All right, Dhruv, congratulations on getting started early, and I hope you'll stay on this track that Firoz has recommended. Firoz, thanks very much for joining in, and thanks for advising our viewers. We'll wrap up on MF Corner, but do stay tuned. Closing bell is up next.